So we've got the state of the global economy in flux. We've seen the implications of that with the SARB downgrading our own growth outlook yesterday and pretty drastically to 3.2% for this year from 3.7% originally, where we still got this debate raging on whether or not we're facing a recession. Where do you stand? Are we teetering anywhere close to that arena?
Good afternoon, Alishia. Yes, indeed, we are teetering very close to that arena. And every doom prophet in the world will tell you right now that we are going into a recession or that we might even be in a recession already. Our opinion is slightly bit more positive than that. Some of the real numbers like world trade numbers and the leading indicator in the US are actually still not pointing to a recession at all. So yes, all the sentiment indicators very negative, but our opinion is that we shouldn't go into a second leg of the recession. Yes, there are some tough times ahead, but we don't believe that there's a reason to fear a recession right now.
George, a lot of that is riding on the health of the consumer and the US consumer in particular. And this is amidst a crisis of confidence that's playing itself out, where there might not be a credit crunch, so the inability to lend is not there, but where there is a lack of confidence to actually lend what is there. So what's going to be the catalyst?
Yeah, as they say, as the US consumer goes, so the US economy goes, and as the US economy goes, so the world goes. So you're 100% correct that the health of the US consumer is exceptionally important. The important drivers for the US consumer has been the housing market. In 2007, 2008, that was what caused the problems in the first place. What we're seeing now is that the condition of the US consumer is improving dramatically. Their debt is reducing, the interest burden on that debt is at historic lows, and slowly but surely the US investor is saving. They've been saving at 6% at this point in time, and hence their position is improving dramatically. So as soon as confidence returns, and as you quite rightly stated, that right now it's just a lack of confidence, the consumer will be back very quickly, and the markets will see that very rapidly.
A lot of that confidence building is placed on policymakers themselves. And we were chatting to Nerina Visser of Nedbank a little earlier on in the show. She's reiterated a view that's come through in this forum time and time again, where it's the lack of decisive action that's actually coming through. And let's use the Eurozone now as a case in point, where policymakers seem to be to and froing with regards to what actually needs to be done to get these economies out of a slump.
Alishia, indeed, the problem is that monetary policy can only go so far. Interest rates in the US are as close to zero as they can get, and in the Eurozone, unfortunately, they raised them earlier on, so they have some space to cut them back again. But interest rates are at historic low levels, so monetary policy has got limited ability to stimulate the economy further. The biggest risk we face now is that fiscal policy becomes too tight too quickly and turns down economic growth. And hence we land in the situation where our solution must be found by politicians. And unfortunately, that makes the markets very nervous right now. We'll probably see a lot of volatility around that, and we might see some social unrest and change taking place as well, which just means that it's not even the same political leaders who's going to have to find the solution over the next 3 years.
And that's exactly what's put in the context, this entire question in terms of the merit of austerity going hand in hand with easing and accommodative policy, which is in fact needed to grow out of this slump. But what's your view within that debate?
As you know, it's one of the toughest things in the world if you have to save at the same time that your income is coming down. Now, how do you do that? And that's exactly what the European economies are facing. As the GDP growth is slowing down, tax revenue is becoming lower, and as that's becoming lower, they have to implement savings as well. And those savings government savings take money out of the consumer's pocket and makes it very, very difficult for the European consumer right now, and hence why their outlook for the next medium term, even the next 5 to 10 years, is pretty bleak at this point in time. Austerity measures in the Eurozone is the one way that they're trying to get out of their debt problems, while in the US they're going about it in a very different way. So it is very different dynamics between Europe and the US.
We're doing a bit of a globe trot this afternoon, George, with so much of a focus on the US and Europe. Are markets possibly taking their eye off China more than they should at this stage of the game, where we've got inflation risks being posed on that end, and added to that, we saw more evidence filtered through yesterday of a possible slowdown in China, with the flash PMI survey coming through from HSBC showing that factory output on that end fell for a third consecutive month in September.
In the beautiful days of 2003 to 2007, when we had the booming commodity bull market, then China was the only focus, and China pulled us through all of that. So obviously now, as the numbers in China start slowing down a little bit, or they're cooling down a touch, now there's a lot of focus on that. But remember, China is still pretty small when it comes to overall consumption of commodities. Fact of the matter is, however, the price gets set on the periphery, and China is the biggest player these days in many of those markets, so they are still an important factor to play. But I don't think the market is missing something by taking the eye off the ball. Right now we're seeing the slowdown in growth, which is what the market is predominantly focusing on. What is surprising, though, is that the markets get so surprised by markdown in growth numbers for problems that we have seen for a long time. The Greece issue has been on the table for a long time, so why do markets get so scared about growth prospects now? That is what is more surprising. So China is actually still a bit of good news. They're still solid as a rock, 8+ GDP growth, so whatever other numbers come out, they are still doing very well.
So we know that you're in charge of managing private client wealth care, and yes, there is a unique solution for every client that's out there. But how's your view on the state of the economy influencing your portfolio build right now and asset allocation, broadly speaking?
If one only looks at the economy, you would probably say, get out of equities, growth is going down, etc., etc. But that is exactly where portfolio management comes in, where a long-term investment philosophy comes in. At Citadel, we apply a value investment philosophy, and that implies that you take a long-term look at the asset classes. And right now, as we look at the world, bonds and fixed income, cash giving you very low returns. And as markets get sold down, the risk-adjusted returns on equities are getting better and better and better. So a typical contrarian approach, what is happening exactly right now, is that as the markets act very fearfully and sell down aggressively and sometimes irrationally, this is as good opportunity as you've seen in a long time to actually purchase equities. Yes, there will be volatility in the short term, but look through this. The European situation will be solved. The American growth will eventually come back. So applying some more risk now is the prudent thing, and that's how we're going about it. So we like equities a bit more. We do not like bonds. We think that the rates are very low. That's internationally. Domestically, they have jumped up a little bit, so they're offering a little bit more value. But cash is still very low, so equity is our preferred asset class.
So where does that put your exposure to the global markets right now, and developed markets in particular?
Well, things have changed very rapidly over the last 2 weeks. The last time I was here with you was 3 months ago. We gave you a strong opinion that we prefer developed markets over emerging markets. The argument was that yes, there will be more growth in emerging markets, but developed markets just offered a bit of more of a safe haven. Also that the prices were very similar, and in fact in many instances emerging markets were more expensive than developed markets, and that just didn't make sense. For the additional risk in emerging markets, you should be getting a bit of a discount for that. Now over the last 2 weeks that has changed dramatically, and emerging markets are slowly but surely trading to a discount to developed markets. So that equilibrium is changing, but it hasn't flipped over yet where emerging markets are cheap. So for the time being, we still prefer developed markets. That placed us in a situation where we preferred as much as possible assets abroad. And with the rand having sold off now, you have to manage that as to how you want to take that forward. But undoubtedly, for the time being, whilst this volatility is around, we still prefer developed markets over emerging markets.
And does that form part of your contrarian, approach to the markets and your value approach to the markets right now, or is there a more significant theme that has come to the fore amidst this entire scenario, where it highlights your position as a contrarian investor?
It is interesting when you do your asset class valuations, then very often what jumps to the top that you should have to start looking at is kind of what everybody is throwing away, but that is an end product of the process that you follow. So it's not that we're trying to be contrarian at all. But if you look at over the last decade, over the last 10 years, the US equity market hasn't given you anything. When you look back 10 years ago, the US equity market was giving you long-term returns in excess, double-figure returns. So it was obvious 10 years ago that you should have invested in the US, and in fact, over this last 10 years, it gave you zero. Whereas now everybody wants to invest in South Africa because we're a commodity-based country, but actually right now, our numbers are showing us that you should be investing abroad.
Of course, the last time you chatted, and I'm not sure on which show it was, but I remember you talking about when it comes to themes coming through on your fund, you were particularly surprised that gold miners had made a particularly stood out particularly within your portfolios. Right now, what's the standing in that regard? Are you still seeing exposure to gold miners? Because certainly they've benefited from what's come through over the last couple of weeks.
You've got a very, very good memory, Alishia, I must admit. Indeed, that was one of the situations that we had, that gold stocks started featuring in our portfolios. In fact, we still have them, and in our top 10 shares, 2 of them are still gold stocks. And yes, they have been good during this uncertain phase, but that's also been a play on the currency. So it's not to say that these will stay in the portfolio for a long time, but the gold theme is still strong. With the Swiss franc being removed as a safe haven, it's chased a lot more people into the gold price to try and go and hide. And so our gold stocks has actually done well recently. Unfortunately, over the long term, we're not big fans of gold stocks because they're not fantastic converters of profitability of the underlying commodity.
Well, as you say, for now, seeming to be paying off. One thing that we are certain of in the current day and age is uncertainty that plagues the market. When it comes to managing some of the downside risk, George, how do you mitigate against that?
It's always the toughest thing, because it's in the good times that people want to take away everything and they just want to share in the bull markets, and that's the times that you have to sell it. So when these tough times arrive, that you have your portfolio in the correct structure already. But the only way is diversification, looking for assets that are not directly correlated to the equity markets. We have to have a decent allocation into hedge funds. Our company has managed hedge funds for more than a decade now, very successfully, and that has most recently proved very healthy in our portfolios and helpful in our portfolios to help with the downturn in the equity markets. But at the end of the day, you are looking for diversification, and it stays an important pillar to our investment philosophy.